Good afternoon, everyone. Uh, Very interesting sessions since morning. Uh, we were sitting here for Vikas's sessions, and I think completely resonate to what he was referring to. If you really look back, right, maybe 20 years back, domestically, PMS was one of the most popular mode of raising private capital. Of course, mutual fund has always been quite a popular mode where people use that as a maybe a more participation in equity with a reasonable level of risk that one could take. And traditionally, there was what we call as a venture capital fund, right? That was long back prior to 2012. There were number of regulatory, tax, foreign exchange related complications in each of those vehicles. And it was making it very difficult for both Indian individuals, Indian investors, foreign investors to participate in some of these vehicles. What happened in 2012 with the expert committee of SEBI is that entire regime of VCF was migrated to AIF. AIF is a far more superior regime, and you have seen the growth of that regime since the regulation got enacted, right? So since the last 12 years, there are more than 1,300 plus AIFs which have got registered. Now, of course, there is a growth that is happening on AIFs even at IFSC GIFT level, which we had a session earlier in the day. There are 100 plus more AIFs which are getting set up there. So clearly, as a vehicle, it is becoming a lot more popular and a lot more in demand. Of course, each of the different categories that we discuss has its own nuances. But in India, when somebody goes to buy a car, however expensive it is, right? The last question always is that how much average does it give, right? That's how our Indian mindset is. And similarly, in India, when you are buying an investment product or selling an investment product, the first question at the end comes that what is the tax that is applicable on this product? And no decision is made till you get a satisfactory answer on that. So with this, what we are going to do in the next 20 minutes, take you through the various implication for maybe the alternative space. What are the tax implication? Over a period of time, a lot of simplification, rationalization has happened, but there are still certain nuances that one need to be careful of. What has also happened in this year's budget is there is a significant rationalization that has happened across asset class, which is a very, very welcome move. If you really see that initially one of the delta between a private sector or a private unlisted and a listed securities, there was a delta in the tax rate, which also was making it maybe the unlisted side a lot more less attractive as compared to the listed one. Of course, the liquidity and the exit are very different, but at least on the net tax proceeds that one would to compare, the tax was becoming a big delta. Similarly, some of the other investment products like immobile property versus equity, there was a different tax rate that was applicable. So all of that have now got rationalized today. Earlier, there was a delta on the listed shares which were exempt and then unlisted were taxable. So that delta got taken out around 4 years back. But now if you really see that all investment products today are more or less at par as far as the tax rate is concerned, except some debentures, except some debt-related products where the tax rate could be very different. And that is what, in fact, after the budget, we've had multiple conversations where unlisted private equity type of scenarios are becoming more and more popular, right? If you go and talk to investors, people are looking at diversifying it because now they feel that with the tax rate being same, they are open to look at diversifying their portfolio to go into more unlisted product. So with this, maybe I can hand it over to Neha to just take us through the various different products and how does the taxation works on each of these products, and then open to any questions, etc., that people may have.
Yeah. Hi, good afternoon, everyone. So as Vikas mentioned, the Cat 3 is the most sought product from a distributor side, and it would be very important to understand the taxability around it, because definitely this is not an easy one for anyone to understand. So what we have on the left-hand side is a diagram which explains typically how the structure looks like. It's a typical pooling vehicle where you would be pooling investors' money and you have a fund manager managing it. Now, the complexity on the taxation side is that unlike a category 1 and 2 AIF, which has a tax pass-through regime, which essentially means that the income earned by the fund is taxable directly in the hands of the investors. In a Cat 3 fund, that kind of a tax clarification has not been provided. So basically, a Cat 3 AIF, which is generally set up in the form of a trust, has to be subject to the complex trust taxation principles. And if anyone in the room is aware, you have terminologies like you would have heard about revocable, irrevocable, determinate, indeterminate, and there are too many complexities around that. So one needs to understand how that essentially functions. But principally, now obviously this product has been there for a while. And as an industry practice, most likely people are offering the income to tax at the fund level, and investors are getting post-tax returns. So obviously at the fund level, one needs to determine how to categorize the income, because there is another avenue out here to decide whether it's a business income or a capital gains, and which is essentially dependent upon the type of product that you're looking at. So if you will come on the right-hand side, as Vikas had mentioned, Cat 3 products have typically a long only, a long short, an absolute strategy, and nowadays we have also heard a lot about the fixed income strategy. So simply put, long only is somewhere you are investing in cash equities, and the intent is to hold it for long term. The absolute strategy is more where you're putting money in derivatives. A long short strategy is somewhere you're doing a mixed strategy. Part of your portfolio is in cash equities and part of it is derivatives. And fixed income is something which we have heard over the last 1 year, where people are looking at investing in securities which are more short-term in nature, maybe like CPs, listed NCDs, GSECs, etc. Now, depending upon the fund strategy, you need to decide how your income is subject to tax. And obviously, because of the trust taxation complexities, there are other aspects that one needs to consider. But to simplify for the group, it's basically today the long-only strategy essentially is offered like capital gains. Your absolute strategy, which is derivatives, would be like business income. Your long short is a mix. And your fixed income depends upon how your fund is structured. Now, capital gains is subject to tax at the rate of 12.5% and 20%. And this is subject to tax at the full, without any deduction for expenses other than for the one you have incurred in relation to transfer. Business income is 30% plus on the net income basis. So earlier the surcharge rate was 37%, which has now come down to in the new regime to 25%. So from a 42%, it has come down to 39%. But interestingly, this is on the net income. So basically your expenses, your management fee, your performance fees that you pay, you get as a deduction. As against in a long only strategy, you don't get those expenses as a deduction, but obviously the rate is lower. So when you are looking at a mixed strategy, which is a long short, you essentially have to bifurcate your portfolio between the two strategies. You have to bifurcate your expenses between the two strategies and accordingly determine what will be your net effective tax rate. And these all things become critical such that you have a policy from day one, such that you are aware about how your effective tax rates would work. Fixed income, unlike this, is basically more of a temporary investment. It depends upon how you conduct your business, how you would be churning your portfolio, etc., to decide it. So it's not a straightforward answer in this category. Last point is very important, which is on the tax on redemption. So most of these products would be either open-ended or close-ended products. Open-ended product essentially means that where you're giving the ability to your investors to redeem after periodical events. And when they are redeeming in a periodical events, obviously as a fund manager, you would collect taxes from them. And you would basically distribute a post-tax return to them. Now, what happens is in a Cat 3 fund, the position is that you offer the income to tax at fund level and you give a post-tax return to the investors. So the unrealized gains are also per se distributed to the investors. So there are certain nuances around it, that because the fund is offering income to taxes only on the realized gains and not on the unrealized gains. And the unrealized gains may actually not be offered to tax by anyone in that particular year. So does that increase any tax nuance for the investors? But this is an industry issue. Somewhere people are trying to manage it by creating at least that much of realized income to the extent of the redemption requests which are coming in. So this is broadly on a Cat 3 AIF.
So just to add a couple of points here is if you really compare maybe a mutual fund or a PMS and a Cat 3, right? And that's the classic question that will come up. And as you saw in the CAMS report, there is a lot more Cat 3 products that happen through a distributor, right? Or through an advisor. The reason it is because I think the strategy itself is complex. Classic category 2, you can say it's a classic private equity fund. You know it will invest in unlisted sector-wise, or it could be startup, or it could be venture, as the case may be. In category 3, there could be a lot of permutation combination that people kind of create their strategy around, and the tax rate on that varies depending on the strategy. One of the key difference in PMS versus a Cat 3 is that in PMS, the investments are held in the individual name. And therefore, the tax, etc., the burden of all of that is for the individual to take care of it. Whereas in Cat 3, everything is done at the fund level, and the net amount is what gets distributed. So you typically, other than the complexity around redemption, most of people will just offer this as not liable to tax again because the first level tax have happened. Similarly, in mutual fund, because you will buy and sell, you will be responsible for your own taxes. So that is one of the key difference, and therefore, one of the important point is that if you have otherwise losses, right, capital losses, etc., in your name, if you have an investment product which is more PMS mutual fund, then you can offset that. Whereas in category 3, all of the losses get offset at the fund level itself. So that is the one key difference that one needs to just be aware of while comparing the different products.
Yeah. So as Kunal touched upon, one of the key questions that you will get from your investors, like, because you're getting a post-tax return, how do I offer this in my return? Where should I be categorizing this? Because ultimately, it's not like my own income. The taxes are not paid in my name. So that is some kind of a nuanced question which will come, and you will have to address it according to that, according to the facts of the investors. Okay, so essentially a Cat 3 fund is more used for domestic investors. We have also touched upon if you are looking at raising money from non-resident investors, maybe foreign nationals, NRIs, OCIs. So on the left-hand side, the structure that you have is more like a traditional structure where you have an investment advisor in India. They would be floating a fund abroad, and they would be having a fund manager outside India. And the offshore fund is pooling money from the non-resident investors, and they would be investing in Indian markets through the FPI route. So the difference between the structure on the left and the right is that in the left-hand side structure, you have an offshore manager, which is managing the fund, and the Indian manager is only providing a non-binding advice. Obviously, this puts limitations on the roles of the manager in India. And to address that issue, there was a proposition from the income tax authorities to get in a safe harbor provision to allow Indian fund managers to directly manage offshore fund without creating any tax nuance for the fund in India. This route obviously has a lot of conditions. I won't get into those aspects out here, but and it's not really something prevalent in the market. We saw quite a few funds took this approval 3 to 4 years back, but not many of them have eventually used it. But simply coming to the tax and the regulatory aspects that is relevant for us, under this route, the FPI, because you're investing under the FPI route from an offshore entity, your NRI money is capped to 49%. So that becomes a very deterrent item when you are, distributing this kind of a product. Second one is from a tax rate perspective, it's on par. Long-term capital gains is 12.5, and short-term is again 20 plus. Important thing out here is that there is no GST, which obviously impacts your IRR. So unlike in a Cat 3 fund where all your management fees, performance fees is earned in India and subject to GST of 18%, in this structure, there is no GST impact. As an improvement to this product, and I'm sure Dipesh has also touched upon the GIFT City structure. So we have seen in last year or so, a lot more people moving the offshore fund to a GIFT City fund. So the structure essentially remains the same. It's just that where you had an offshore fund in a jurisdiction like a Mauritius, Singapore, Luxembourg, or Ireland, now people are proposing to set up the fund in GIFT City. Now, as GIFT City essentially is a non-resident zone from a FEMA perspective. So when you are investing from that zone into Indian equity markets, again, you'll have to take an FPI route. From a tax rate perspective, for the investors, nothing changes. There is a small delta in the surcharge rate. From the manager's perspective, there is a good tax holiday for 10 years out of 15 years. So it's a very lucrative product for them. From a GST management fee perspective, there is no GST management fee applicable because this is considered to be an export zone. It's an SEZ zone where it is set up. The key aspect from a marketing perspective is that recently IFSCA has allowed and SEBI has allowed the fund set up out here to raise up to 100% money from NRIs. So this becomes a very important aspect as a marketing product. If tomorrow you are looking at, or your fund managers are looking to set up funds where they want to raise more than 49%, then GIFT City can be a go-to structure for them. Obviously, it's a very good product from the perspective of also the fund managers because they're getting the tax holidays. If they are Indian GPs, then the entire structuring for them becomes very easy.
So see, the NRI point is a little important because see, today, if we were to look at the traditional structure, which is the FPI structure, there's a cap of 49% NRI money. And we've had a lot of requests from people coming up that we want to access more NRI capital because there is a lot of NRI capital that is available outside India. So how do you tap that NRI capital? So GIFT City is that one alternative which is available. Of course, the other alternative was to directly into the Indian AIF. But then there is a tax that is applicable to the manager with respect to that. And therefore, if I were to compare an offshore structure vis-a-vis a GIFT structure, then GIFT structure gives you a lot more flexibility to raise NRI capital and give the benefit of the tax of an offshore structure.
Also important is that the tax, you have a window up to March 31st, 2025 to relocate fund to GIFT City, and such relocation will not be subject to tax. So there are a lot of inquiries of people coming in right now if they can look at relocating the Mauritius fund to GIFT City, because obviously it's much more beneficial even from a fundraising perspective.
And what they've also done, which is a great thing, is that they have kept the compliances, the registrations and everything at par with an offshore fund. So a guy who's otherwise coming in a Singapore, Mauritius or a Delaware fund will absolutely not feel any difference when he's coming in GIFT City. And with the flexibility of able to go beyond 49% for the manager to get a better tax rate, etc. So it kind of win-win for the investor as well as for the fund manager that is happening.
So essentially what Kunal is mentioning also includes that they don't need to file any tax returns or take any permanent account numbers in India, because that is one of the apprehensions which a foreign investor generally has, that they don't want to have any tax filings in India. So subject to certain conditions, that is possible. Another big change which came in this budget was that earlier the GIFT City structure, which provided for certain tax benefits, was given only to Cat 3 AIFs. And a Cat 3 AIF in GIFT City basically required you to raise money from investors who are either accredited investors or investors who are giving you a minimum check size of USD $150,000. They have extended certain tax benefits to retail funds as well. So that means you don't have any minimum cap on the amount that you need to raise from investors. So basically now you can target retail investors more as well if you're looking at setting up funds in GIFT City. So this is another thing. So while we were talking right now about a lot about products coming in India, there is also about the outbound products. So from an outbound perspective, you can have residents setting up funds in GIFT City, which would be investing in overseas securities. If the room is aware, there was this entire regime of specified mutual fund, which had come in the Finance Act 23, which had created a lot of apprehensions on basically even funds which were investing in overseas sectors or in ETFs and all, to be treated as specified mutual funds where the income was being subject to tax at full ordinary rates. Now, because of the clarity which has come in this budget, where they have said that only funds with more than 65% investment in bonds and debentures or money markets in Indian SEBI, as per SEBI regulations, will be considered as specified mutual funds. Essentially, all your outbound products, where you are either investing in stock of Apple or of Google, or you're investing in overseas funds, would not be treated as specified mutual funds. And whenever you are earning any capital gains on that, you will be getting a 12.5% tax rate. So earlier there was a risk of that income being subject to 30% tax, which has come down to 12.5%. Obviously subject to how the overseas market performs, but this now opens up a lot more avenue for people to set up funds out there.
Yeah. Just a couple of points on this. What has also happened is that if you really look at, and one is the public market and the listed side of it, but even if you see private equity side of it, overseas fundraising has becoming a big challenge, looking at how US, Canada, some of the European countries are performing. And therefore, we are seeing many requests where global private equity funds are wanting to access Indian domestic HNI capital and family office capital to be able to raise in their fund, right? And therefore, today, if any family office or any institutional investor or an individual were to participate in an overseas fund, there are a lot of regulatory and tax restrictions which are there. This particular alternative has actually made that thing possible, that tomorrow, if you were to invest in say, an ABC global fund, then you could look at setting up a feeder in GIFT where you can actually try and capture more HNI capital or institutional capital from India, which can go there. Of course, the taxation regime is different in GIFT, depending upon the ultimate end product that you're investing in, whether you're investing in equity, whether you're investing in public market, etc. But the tax rate could be long-term capital gains 12.5 at the AIF level as well. Or if it is a normal fixed income type of product, then it could become at the highest rate of 39%. And I think with this, what we also wanted to quickly touch upon, and I know we are running out of time, was that one is, of course, category 3, right? Category 3 is popular, has always been popular, etc. But with the change in the tax rates and overall with so much of liquidity available in the country today, and more like 1 crore has not become a big check size for people, a category 2 AIF is also becoming extremely popular, right? Which is, I think, the next slide that we'll touch upon very quickly. The good part of category 2 is that the tax rate is simplified to a great extent. And thanks to all the representation, everything being made over a period of time, the taxation of this is simplified to a great extent. There are still some timing issues. There are still some bit of ambiguity, but those are clarified to a great extent.
Yeah. So essentially, as Kunal touched upon, so basically, the left-hand side is a traditional Cat 2 structure where you will have a feeder in a jurisdiction like Mauritius, Singapore, and all. But we have heard a lot in the news nowadays that Mauritius is being under complete scanner, and in order to increase people's, confidence in that sector, the kind of KYC that is required from investors is going up very high, and therefore there are certain apprehensions that investors do have while investing through that jurisdiction. So we are seeing more and more trend of people looking at setting up a feeder fund in GIFT City, and obviously this can be used either for a PE fund or for a credit fund, and each of them have a lot more tax benefits. I think we're short of time, so I'll not really touch upon each of those aspects, but definitely it's a very good product, from your investor standpoint, because they get a credit for the Indian taxes, and plus they give a lot of concessional tax rates, which becomes very important for credit funds. So this will be a very, something that you should look upon when you're looking at PE sector, definitely.
Yeah. So maybe I'll summarize. So overall, if we were to just summarize everything, I think Cat 2 and Cat 3 are becoming more and more popular as compared to a traditional PMS and mutual fund. Not to say that PMS and mutual fund will not there. People will allocate and reallocate their overall corpus that they look at it. Cat 2 is very simplified as far as the tax is concerned. It's a pass-through. Investors pay the necessary taxes. There is a withholding that happens on Cat 2. Pretty simplified, pretty tried and tested, etc. Cat 3 is still a little complicated as far as the tax is concerned because the product itself is complicated on whether it is long short, whether it is fixed income, whether it is only derivatives, like multiple permutation combinations are coming up. So therefore, as a group, this is very important to study the product, study the tax implications so that you can guide the investor right to say that what is that they are investing and what is that they eventually get. So thank you everyone.
Thank you.
Well, thank you so